Hey guys, welcome back to part 3 of this company analysis series. Today's video is all about corporate actions. Now, corporate action is an event initiated by a public company that could bring an actual change to the debt or equity issued by that company. Now, as traders, we need to be well aware of these corporate actions because if we own a position in the stock, it will impact our P&L in most cases. And I'll be going through in this video why that might be the case. So what are the common types of corporate actions? Well, we have cash dividends, rights issues, stock splits. This includes reverse stock splits, and share buybacks. So I'll cover these 4 types of corporate actions and how it can impact the share price of a company. So first up is dividends. Now, a dividend is simply a cash payment to ordinary shareholders of a company. A cash dividend is subject to approval by the company's board of directors. Now, because share prices represent future cash flows and future dividend streams, these are incorporated into the share price. So what do I mean by this? Well, the impact of a dividend announcement is reflected into the company's share price. Here is an example using the pharmaceutical company Gilead Sciences. Gilead announced a dividend in Q1 of this year of 71 cents per ordinary share. So for every share you hold of Gilead's, you'll receive 71 cents. Let's now have a look at the timeline of events based on that announcement from Gilead Sciences. So there's the date the dividend is announced. That was 4th of February. Then there's the date the dividend is paid. So that's the 30th of March. In between is the ex-dividend date and the record date. Now, after a stock goes ex-dividend, the share price typically drops by the amount of that dividend paid to reflect that the new shareholders are not entitled to that payment. And you can see that here in this chart where Gilead Sciences' share price drops on the ex-dividend date. The record date is the date when the company reviews its list of shareholders to see who is entitled to that dividend payment. Now let's have a look at rights issues. So a rights issue is an invite to existing shareholders to purchase additional shares at a discount. The existing shareholders are given the right to purchase or receive these shares before they're offered to the public. So here's an example of a rights issue. It's a theoretical example. So let's say we have a portfolio of 1,000 shares, which is worth $1.50. So our portfolio is worth $1,500. Then this company, let's say it's called Company X, there's a rights issue, 4 for 1 at $1. So what that means is for every 4 shares we have, we're entitled to 1 additional share at $1. So it's 50-cent discount on the current market value. So that means we're entitled to 250 additional shares at $1, which would cost us $250. If we took those rights, it means we would have a portfolio of 1,250 shares at $1,750. So now we can work out the X right value per share because our portfolio is worth $1,750 and we have 1,250 shares. That gives us an X rights price of $1.40. This means the theoretical X rights price per share is 10 cents lower than the current market value per share. So in theory, after the rights issue is done, the share price should fall by 10 cents per share. Now here is a real example using AMC, the Reddit community favorite stock, with the headline stating the company was looking to raise $25 million. Look at the reaction to the share price. The reason is twofold for this. 1, the share price will be discounted because new shares will be offered at a discount. And 2, there's a dilution effect, meaning existing shareholders may want to sell out. This also wasn't the first time AMC raised money by issuing more shares, as this report suggests. Next up is stock splits. So a stock split is when the company divides the number of existing shares into new additional shares to boost the stock's liquidity. Although the number of shares outstanding increases by a specific multiple, the dollar value of the shares remains the same compared to the pre-split amounts because the split doesn't really add any real value. Here's an illustration of what I mean. So let's say we have 1,000 shares. Then a company announces a stock split 4 for 1. So what that means is for every 1 share, we'll now have 4 shares. So what that means is now we'll have 4,000 shares after the stock split. So it's cut by 4. So initially we had 1,000 shares. Now we have 4,000 shares. In terms of value, the value of the shares remain the same. A reverse split is the opposite of a stock split. And this will be implemented by a company that wants to force up the price of its shares. For example, if a shareholder owns 10 shares of a stock valued at $1 each, it will only have 1 share after a reverse split of 10 for 1. But that 1 share is still valued at $10. A reverse split can be a sign that the company's stock has sunk so low that its management wants to shore up the price, or at least make it appear that the stock is stronger. Here is a real example of a stock split. So at the end of July 2020, Apple announced a 4-to-1 stock split. Have a look at the chart of Apple. You can see the stock actually rose on the announcement, although this may have been linked to the blowout earnings report as well. The stock split took effect at the end of August, and the stock did rise initially before falling. This isn't the first time Apple has announced a stock split. Here is a history of Apple's previous stock splits. The final corporate action we're going to look at is share buybacks, which is simply a company deciding to purchase its own shares from the market. Now, a company might want to buy back its shares to boost the value of its stock and improve the financial statements. Here is an example of Warren Buffett's Berkshire Hathaway announcing it will be buying more of its stock this year. And you can see from the chart that the stock rallied the next trading day. Now, there's a few reasons why a company might want to do this. One is the stock price has tanked, and buying the shares at a low price makes sense, which will also boost the share price. But it's also another way to give back to the shareholders, because it will boost the stock as the shares outstanding, i.e. the supply, is reduced, thereby pushing the price up. So that wraps up part 3 of this company analysis, where we've looked at corporate actions such as cash dividend payments, rights issues, stock splits, and share buybacks, and how it impacts the share price of a company. I hope you found this useful. Thanks again for watching. Remember to hit that subscribe button so you don't miss any future videos. Thanks again. See you at the next one.